This is a recording of Financial Myth-Busting with Don Bennett for Sunday, June 22nd, 2014. You can listen to this program live every Sunday morning from 11 a.m. to 12 p.m. right here on 105.9 FM and AM 630 WMAL.
Securities offered through Western International Securities Incorporated, member FINRA SIPC. The views expressed on this program do not necessarily reflect the views of this station. Proper advice depends on a complete analysis of all facts and circumstances. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.
You're listening to Financial Myth-Busting with Don Bennett.
It might seem crazy what I'm about to say. Sunshine, she's here. You can take a break.
And this is Don Bennett with Financial Myth-Busting, and we are live today. So if you have any questions about your portfolio or the economy, feel free to give me a call. And if you can't call, you can always become a fan of Financial Myth-Busting or email us at like us on Facebook at Financial Myth-Busting or follow us on Twitter at Don Bennett FMB on Twitter, or you can do the old-fashioned thing and just email us. And just go to BennettGroupFinancial.com and click on the Contact Us in the upper right-hand corner of the page. And I will try to answer you in this show or an up-and-coming show, or I will just call you personally to make sure that you get the answer. You know, at the bottom of the hour, we're having my very favorite analyst, Michael Belkin. He's going to be on, and the reason why he's my favorite is because he doesn't always talk about the past. To me, so many analysts in my industry always talk about the history of what went on, and I'm interested in the future. And he's that good, and he's going to be talking about the shocking new details about the lengths central banks are going to prop up the stock market because of a very interesting article that came out with the Financial Times on June the 16th that was eye-opening. So there's been a lot of fallout from that worldwide, as a matter of fact. But I also wanted to, before I start the show, to dig into something. We are going to announce today that Financial Myth-Busting is going to be joining Radio America in a few weeks. And so we can broadcast far and wide on dozens of stations throughout America. So if you can't get enough of me and what I have to say, then you're in luck. This is going to be 2 whole hours and on most stations for Radio America, and it's going to be from 10 a.m. to 11 on Sunday mornings. So we're still on Sunday, but we're going to start at 10. And I don't know if we're going to be carried by WMAL at this point, but if you have friends or relatives you think that could benefit from what we serve up here on Financial Myth-Busting, just make sure to tell them to check the radioamerica.org for a schedule, or check with their local stations to see if we're broadcasting out of there. But again, we go live nationally in mid-July. And if you can't catch any of the shows because of commitments like church or family time, you can always go to financialmythbusting.com and you can catch the podcast of our new 2-hour show. I hope you follow us. We've had so much fun here at WMAL for the last 3 years, and we really look forward to bringing this message that we talk about the truth, and knowing the truth will help you manage your portfolio throughout the United States. So it's something that we are just absolutely thrilled about. So here we are. Janet Yellen, Wednesday, she was speaking, the Federal Reserve, and then we had this interesting article that came out regarding the Federal Reserve from the Financial Times. And the most fascinating thing came out of it, this development that was going on in Europe after the article came out, because essentially this article was saying that central banks around the United States, or around the world, but the United States being the primary one, has actually put close to $29 to $30 trillion into U.S. equity markets. That's right, 29 to 30 trillion, when U.S. equity markets worldwide are worth about approximately 60 trillion. So in other words, they own 50% of the U.S. equities. Central banks worldwide own 50% of the equities in the U.S. markets and all the other markets. So this development I was talking about, there are these rallies that are spreading throughout Europe, and Germany in particular, protesting what they call a corrupt and dying global status quo, which is the Federal Reserve. So they're basically saying, according to the organizers of these rallies, that they've spread up to 100 cities, and right now 3 countries are participating, pretty much still all in Germany, though, and these combined attendee bases of these rallies are about 20,000 people apiece. So it got me thinking, and I want to ask you, do you think we still need the Federal Reserve? I mean, if the Federal Reserve was abolished, what do you think will happen? I mean, do you expect America to actually start protesting against the Fed? I mean, this is Europe protesting against the Federal Reserve. Maybe they maybe we're too close to it, and so we don't see it, but they obviously see something. And I do think it was this article in the Financial Times that triggered it, and we're going to be talking a little bit more about it. So I'm wondering, do Americans actually expect to protest against the Fed? I want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296. I mean, or, here's this, are we resigned to the fact that every paycheck that we get is actually buying less? Because that's what's happening here. And then, of course, if the Federal Reserve was abolished, I'm wondering what would or what should be put in its place. Look, I don't think this debate is new. I was just surprised and fascinated that, this was happening in Germany and throughout Europe. So I just want to know. I mean, many people believe we need to get the Fed out of the financial markets, kind of get their fat thumb off the scale and let interest rates clear the market based on true supply and demand, because we don't have that now. And let the traders and investors truly be, at risk when they invest, as opposed to being in this Fed-fueled casino that is happening. So I'm going to ask the question again. Do you think we need the Federal Reserve? And I want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296. And also, do you think that free markets should be allowed again? Because we don't have them anymore. We have controlled, manipulated markets. I mean, should true supply and demand be what the markets and the economy be based on, instead of the Federal Reserve's making the decision and injecting printed money into these markets? So I want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296. And like I said, we had a very interesting week. In particular, this week is interesting for your portfolio. And part of this, of course, was on Wednesday. The Federal Reserve Chair, Janet Yellen, once again gave us plenty to talk about as she was confirming to everybody that we don't have a stock market bubble. That's right. She said that. And she says, yes, the U.S. economy is recovering and that there's absolutely no inflation in the United States. And yes, there were complaints about her explanations to all those questions because she honestly gave weak answers with no substance. And then, of course, the IMF, which is the International Monetary Fund, came out and warned the U.S. Federal Reserve that they should be mindful of financial stability, quote unquote, which, of course, flew right in the face of Yellen's pep talk that all is well here. And then, of course, last but not least, the Financial Times newspaper came out with one hell of an opinion piece, which pretty much turned a conspiracy theory into a conspiracy fact. So let's start with Yellen first. Now, Wednesday's Fedapalooza was full of Q&As, of which the questions were pretty smart. I think they were pretty good. But the answers from Janet Yellen, the Fed chairman or chairwoman, was at the very least, I think, weak and only a semblance of an answer. Now, David Stockman, the former director of the Office of Management and Budget and former guest of Financial Mythbusting, he's been on here, wrote about Yellen and what she said on Wednesday in his Contra Corner blog. And this is what he said regarding Yellen's performance. He said, quote, "The only thing that can be said about Janet Yellen's simple-minded paint-by-numbers performance on Wednesday is that Keynesian hypothesis is complete," unquote. He then went on to write, quote, "American capitalism, and all political life too, is now ruled by a 12-member monetary Politburo, which is essentially accountable to no one except its own misbegotten doctrine that prosperity flows from the end of a printing press," unquote. Look, I think that Stockman is right. And, for over 3 years now on Financial Mythbusting, I've been explaining the massive crater that the Fed has been digging, which is the more they print money, the weaker the U.S. economy becomes. Honestly, all the Fed has done is lift asset prices and lift the cost of living for all Americans. But at the cost of living. But, here's the thing. The cost of living increases are higher than wage increases. So the average American is actually getting poorer, not wealthier. Yellen's saying everything's getting better, but it's not. Problem is, Fed Chair Yellen doesn't see any of it that way, especially regarding inflation. I mean, look around you. Haven't you noticed that prices on food and water and gas and electricity and, gosh, almost anything else is going up dramatically? Yellen wants us all to disregard what we are seeing in our daily lives, and she wants us to believe that inflation is completely under control. Look, I'm telling you right now, I don't think Yellen's being malicious. I don't think she's doing this intentionally, but I do think that the inflation rate has been, the way that they calculate it has been changed so many times since the 1920s, like almost 20 times, that at this point it bears so little relation to reality, which means the Fed's benchmark inflation indices are essentially meaningless. And I don't think she knows the difference. In fact, if inflation was calculated the same way it was back in the 1980s, the inflation rate would be close to 10% right now. But again, you wouldn't know that listening to Yellen last week. I mean, the other day, the Bureau of Labor Statistics announced that the index for meat and poultry and fish and eggs have soared to an all-time high. And again, if our paychecks were increasing at the same rate as inflation, perhaps most American families would be able to weather all of this. But unfortunately, that isn't the case. Inflation is an invisible tax we all must pay, and it is systematically eviscerating the majority of lower and middle-class Americans. Yet, Yellen dismissed the Bureau of Labor Statistics as just quote-unquote noise. That's what she called it, noise. As for the high-income Americans who aren't being touched by this, well, I happen to think most are stepping into another type of hidden trap. And Yellen actually alluded to it, but I don't think she knew she was doing it. She was asked, is there something out of place with the S&P 500 hitting an all-time high? And her answer was, quote-unquote, no. Then she went on to justify her no frothiness comment by saying that the Fed has this stock model that they watch, and whenever they get a feeling of, good or bad valuations, they let us know. So apparently there are still good valuations on the stock market, this stock model that the Fed watches. I don't know which model that is. So she concluded that equity valuations are at a historical norm. In other words, no bubble here, right? But a number of people disagree, and I think major people disagree. Even J.P. Morgan wrote after this, quote, even assuming trailing earnings are valid, sustainable and not goosed by the Fed itself, the most recent median S&P 500 price-to-earnings ratio as of this moment is higher than 89% of all PEs in the history of the market, unquote. So let me just translate that for you. Equities have only been more expensive by just about 10% in the whole history of the S&P than they are right now. And she's telling us we don't have a bubble. Okay, now here's the icing on the cake. The trend of overheated assets was again brought to our attention from the Financial Times opinion piece I kept talking about. It was written by Kevin Warsh and Stanley Druckenmiller, where they reported that a cluster of central bank investors have become major players on world equity markets. And the official report on this was also published this past week by the official Monetary and Financial Institutions Forum, where they confirmed that $29.1 trillion in stock market investments are being held by 400 public sector institutions in 162 countries, which is contributing to the overheated asset prices in the stock markets, including the U.S. stock market. China's State Administration of Foreign Exchange has become the world's largest public sector holder of equities, and I suspect the U.S. Federal Reserve is not far behind. So, there it is. Central banks, including our own Federal Reserve, are the ones pushing up the stock market. That being said, I'm just thinking it can't go on much longer since it's been 5 years of building out our debt balance sheets. And that means exiting this unconventional monetary policy is going to be very, very painful on all of us because no one's ever seen anything like this. So as I said, and the question I'm asking out there, do you think we still need the Federal Reserve? And I find it fascinating that they're staging these rallies in Germany and Europe because they think that the Federal Reserve is corrupt and it's a dying global status quo. Do you agree? I do want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296. Again, dozens of rallies comprised of thousands of people are spreading throughout Germany, and apparently 3 other countries are coming into Germany to participate, and they're protesting the corrupt and dying global status quo, in particular the U.S. Federal Reserve. So I think they're pushing back on all central banks, but in particular ours. So I'm wondering, should we abolish the Federal Reserve? Do you think that we still have free markets out there? I don't. And are free markets today in the United States just a fallacy? I want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296. And when we get back, I'm going to give you Ron Paul's opinion, which, by the way, he actually presented back in 2009, so he's a bit ahead of his time. This is Dawn Bennett, Financial Myth-Busting. Stay tuned.
105.9 FM and AM 630 WMAL. This is Financial Myth-Busting with Dawn Bennett.
It's just been a fascinating week to me to see so many different things come out of this Fed meeting, Janet Yellen's comments and what people are saying about it, as well as this article in Financial Times, which I think is just turning everybody's world upside down. And, of course, oddly enough, late last night I was preparing the show, and I was noticing just dozens of rallies are occurring primarily in Germany. But they say there are people from 3 different countries coming over to participate. And they're saying thousands of people are spreading throughout Germany protesting the corrupt and dying global status quo of central banks, in particular the U.S. Federal Reserve. They actually blame them for leading this. And so I asked this question, should we abolish the Federal Reserve? And back in 2009, I was saying that Ron Paul believes this to be the case because he believes they cause all the trouble. You know, a monetary policy of easy credit and artificial low interest rates, he says, are the main source of the financial bubbles we experience, and all the corrections we have is us trying to fix what the Federal Reserve has done. So do you still think we have free markets? I want to hear from you. I'm at 1-855-884-DAWN, and that's 1-855-884-3296, and I'm going to take Eugene and Sterling. Hi, Eugene. How are you?
Hi, thanks for having me on. Congratulations on you being a proof that there is a free market. You're going on to the American Radio Network.
Well, thank you very much, Eugene. I hope, my job is to continue to put the word out there so that I think Americans can realize the difference of what it was and what we are today. And we need to go back to what America was built on, which is, free market principles. And we just don't have it anymore.
Well, pound for pound, inch for inch, minute for minute, you provide more economic inspiration for those of us who are working, at this level, at the grassroots level, at the free market level. To answer your question, yes, to the degree our country was founded, and the whole principle of our country was to have this free market principle and decentralization of federal power.
Right.
Here we have the Federal Reserve. So yes, I agree, the Federal Reserve should be abolished, and frankly, state banks or state money are what some people promote, like Bob Marshall of Virginia, who's been around for 30 years in the House of Delegates. He's promoting that, and of course, the statists or the people who want centralized power are kind of frightened of your, freedom talk. They're frightened of, loosening it up a little bit and allowing for the profit to be the motivation, which is really the foundation of our country.
So do you think that the Fed creates 100% of our booms and our busts in the stock market?
Those are contrived in a macroeconomic level. It's contrived for show and public relations. The real money is where you are preaching. The real money and the real profit, the real motivation for the markets are where you're coming from, which are pull out the reserve, eliminate the reserve, take out the controls, and let the real people who actually know how to move the world economy, let them free. They're in prison. You're being restrained right now, believe it or not. And all of us who believe in the free market are being restrained. You're being basically imprisoned.
Yeah. No, it's true. Actually, it is true. Without going into too much detail, but we are feeling that. Here's the thing. I just think the Federal Reserve is systematically impoverishing the American people because they don't acknowledge what's going on. They're not acknowledging inflation. They're not acknowledging that our paychecks are buying less. And I just wonder, are the American people just going to sit back and take it? I mean, isn't it ironic that people in Europe are seeing this better than we are? And I'm wondering if these rallies will actually make their way to America.
Only if you talk about it. I mean, you have to understand, we have to go outside the country to get information that really doesn't get covered by the local media. So for your vision of what you see for the world is actually the real vision, the actual correct view of the economic model. So while the Europeans are there... That
will benefit everybody, by the way. The free market will benefit everybody. Higher,
Right. I'm saying your vision of the world is a worldly, moral vision for everyone's benefit. And those people in Europe are feeling that debt crises more acutely than the United States. I think the United States, the average citizen has to hear you, has to see it for themselves. And they just have to look at their paycheck. And,
it's crazy.
It's hard to read that paycheck. They got all that money going to the government.
Yeah. Eugene,
now you're saying it's going to the Federal Reserve, it's kind of like an obtuse or, it's not very understandable, but they have to understand the economic principles to comprehend what you're talking about.
You're absolutely right. Eugene, thanks for calling in. Thank you so much. I just think the U.S. Federal Reserve is hiding behind their elaborate structure so they can't inflate our money supply while at the same time creating the false impression that they're looking out for our best interests. I just don't think that that's what's happening. You know, the Federal Reserve System is the primary reason why our currency has declined in value tremendously, and our national debt has gotten, more than 5,000 times larger over the past 100 years because of them. So those aren't good things, and I'm worried about that for all of you out there, in particular also for your portfolios. Remember to stay tuned. We've got Michael Belkin, and he is a tremendous analyst with so much insight. He is, like I said, always in the future and never in the past. This is Dawn Bennett with Financial Myth-Busting, and we'll be right back.
This is Financial Myth-Busting with Dawn Bennett.
So my very favorite analyst, Michael Belkin, is here. Now, Michael's an institutional and hedge fund consultant, as well as the publisher of my preferred weekly reading, the Belkin Report. Now, one of my favorite sections in Michael's weekly Belkin Report is a portion dedicated to what he calls press clips. And in this section, he highlights what the world press is seeing and hearing in the financial universe. This past week, that section was about central bank manipulation, with the focus on the Financial Times June 16, 2014 piece about how central banks and institutions have poured close to $29.1 trillion into equities, including gold. And this is where I want to start today. Michael, welcome back to Financial Myth-Busting.
Hey, thanks for having me, Don.
So to my mind, this past week went from a conspiracy theory, and then it became a conspiracy fact when the Financial Times reported that a cluster of central bank investors had become major players in the world equity market, investing an estimated 29 to 30 trillion in equities. And so I'm wondering, I was just thinking about this, since the world equity markets are about 60 trillion, does that mean, and I'm hoping I'm thinking about this correctly, that the Federal Reserve and other central banks own nearly 50% of all stocks worldwide? I mean, do you see it that way?
It's pretty crazy, isn't it?
Yeah,
I think that number is kind of a generalization. Nobody knows for sure. It's a report that came out that the FT got a hold of.
Yeah.
It's kind of ironic. Some of these guys are actually my clients. Some of the sovereign wealth funds around the world, and I'm telling them to sell. But they are undeniably a factor, beneath the surface, and they have been for a while. Like the Norwegian Wealth Fund, owns like 1 or 2% of all the stocks in the world, and the Chinese Wealth Fund is gigantic. But I just think it's an example of the greater fool theory. At the top of every bubble, somebody comes along. The Japanese bought Pebble Beach golf course at the top of their bubble. And it turned out to be a disaster and a bad investment. There's one other thing in this week's report on this subject. Corporations, in this week's Thursday's FT on the cover story, I don't have the exact number in front of me, but it's several $100 billion. Corporations are borrowing money and buying back their own shares. So that's another.
Right, that was
quarter,
another factor. I saw
yeah,
that.
It's like
that's right.
$300 billion, $300 billion. That's huge. That's like billions of dollars every day of companies. And it's a huge number. I haven't quantified this yet, but I think it's equivalent to all the earnings that the S&P 500 companies made in the first quarter. So basically they're pouring all their money into buying their own shares to prop up their stock at the top of a bubble so that they, CEOs can reward themselves with stock options and keep the price up. It's a pretty strange, warped world we live in, where the stock market has become, like a lever in a cage that a rat can push, to feed itself, sugar water or cocaine or something, and they'll just keep pushing the lever until their bodies blow up, basically, I think.
So who is the central bank going to sell to if they want out? I mean, how does a central bank successfully exit this unconventional monetary policy?
A very good question. Who will they be selling to?
Right.
So I think in the long term, it's obviously both the central bank buying and the corporate buying is obviously bearish long term. It seems ridiculous at the moment. It seems like the market will never go down.
Right.
But if stocks fall 40, 30, 40, 50%. So on the other side of this equation really is public confidence in the market. And I think that public confidence in the market, that, this is Yellen, Janet Yellen, she's doing everything to squeeze people into equities and to keep them positive. All her public comments, in her press conference this week, they're designed to, smiley face, here's the grandma telling you to buy stocks, it's okay. How can you resist the siren
appealing
call?
to your emotions.
Yeah, but once that, I'm convinced that once the public perception of risk in the market changes, public selling can overwhelm all of these other forces that we're talking about. And in fact, the psychology of central bankers and the psychology of corporations can turn on a dime too, So, ultimately, now,
we've been waiting for this dime for 5 years. What dime is it going to be?
So what I'm telling, the way to play this, there are great ways. I'm not saying there's going to be a crash, on Monday morning or something like that. Ultimately, I think the market's going down big, and that we're at the top of a bubble. But the way to play this, for my institutional clients, there's been this huge shift into defensive sectors. So institutional portfolio managers are getting defensive beneath the surface of this market. For instance, the consumer discretionary sector, which led the rally for since 2009, is down on the year, with the S&P up 6 or 7% or something. And that's the biggest holdings of hedge funds. So the things that are outperforming are utilities, energy, consumer staples, things like that. So there's this strange movement into defensive and out of cyclical. And for your listeners, what's really starting to work is gold. Yeah. So gold mining companies, the GDX. The two things that I recommend for individual investors are GDX and GDXJ. Those are ETFs of gold mining companies. GDX is major, GDX is minor, and they really took off this last week. And it's something I've been recommending for a while here. But let's see, GDX is up on the week. It's up 22% on the year. On the week, up 7%. And GDXJ is up 32% on the year. So the gains that you can get from gold mining, inflation plays, and also it's not just inflation, it's an anti-central bank asset. When gold rallies, it's a thumbs down on what central banks are doing. It's a vote of no confidence in the monetary policies of the Federal Reserve and the ECB and the Bank of Japan and the Bank of China and every other central bank in the world. So when gold rallies, it's basically saying, you are wrong, we don't trust you. And I think it's just starting. I think that gold mining companies are the place to be. They're leading everything else this year. And I think they will go up when the market goes down, and they're going up even when the market goes up at the moment. So I think that's the place to be for individual investors at the moment.
So explain something to me, Michael, because I still can't get my arms around it. If central banks around the world, of course, including the Federal Reserve, is put in $29.1 trillion at this point, it's almost as if it's building a floor underneath the price of stock prices. So when you talk about a correction, which hasn't come in 5 years, where is it going to come? What's going to be the trigger?
Like I said, public psychology. So when you start, so we're still getting inflows into mutual funds, and so there's like a three-pronged thing going on where central banks are buying beneath the surface, and corporations are buying their own shares, and individuals are buying small, not big. I think that when the individual selling starts, and basically you can't make the market go up when the economy goes down. And we have this illusion of economic strength, but actually corporate earnings were down in the first quarter, and maybe they'll be up a little bit in the second quarter. But the economic expansions, trees don't grow to the sky, and basically the global economy is beginning to contract. China is in a big mess. Emerging markets that sell stuff to China, everything's sort of beginning to shrink. We have wars going on around, obviously, in a couple places and around the world, in Iraq and the Middle East. The price of oil is rising. These are all negative events for the economy, and I think corporations will begin to announce weaker results and losses. And, I'm nervous about retailers. Retailers are down on the year. We have a lot of kind of teetering retail companies, the primary, residents of malls in this country, Sears and JCPenney and all these big chain, big box chain stores, as well as a lot of specialty retailers. So I'm expecting sort of bankruptcies and kind of shock, not an overwhelming crash at first, but just a wave of weaker economic news and corporate earnings, and then people wake up and say, like, what am I doing in the stock market here? The earnings are the market's trading at 17 times earnings. The more long-term average is more like 13, 14, and when earnings start declining, there's really no room for error in them. And so we're talking about a change in psychology. Obviously, it hasn't happened yet.
No.
So, but I'm telling you, institutional investors are going defensive beneath the surface, and the gold mining, the rally in gold stocks and gold shares and gold itself is saying, something funny is going on and we don't trust it.
Yeah, I think last week was a turning point. Let me ask you something. If the Dow and the S&P are priced where they are because of unnatural buying, what do you think they would be trading at on their own today?
Well, the best answer for that is the stock market went down 50% in the last two recessions. So in a recession, down 50% is sort of a kind of a benchmark. So it went down from the top in 2000 to the bottom in October 2002, down about 50%.
Right.
Down more than 50% from the top in 2007 to the March 2009 low. So basically, ballpark 50% downside risk in major stock indexes. More the things that went up more in this last cycle were small cap, things like the Russell 2000, which is hardly up on the year. It's really lagging. Again, it's the leaders of the previous rally are acting weaker beneath the surface of this market. So small caps are not the place to be. Probably could fall more than 50% over the course of a bear market, not overnight.
Right.
But over the a couple of years it took in each of the last two events, and that's coincident with a recession, with an economic contraction, and so. That's what I'm telling people, downside risk. And the way to play it is to be, defensive in sectors, long, short. You can be market neutral for hedge funds. That's who I advise. You can be long energy stocks and short consumer discretionary. A lot of technology stocks look weaker to me. That's not the primary area where I would be short. But I think the opportunities are on the short side. A lot of my clients are short sellers. I see a lot of names that I think have a lot of downside risk in the market. So I would be shorting things for professional investors. It sounds crazy with the market going up. It seems like it's strong every day.
Yeah, but to your point, though, when there isn't fundamentals pushing it up, it can't go much higher. I mean, my worry is it can't go lower because they've got a floor built in, but it can't go higher because the fundamentals aren't there. Let me ask you something. The Fed Chair, Janet Yellen, this past week was talking about this some sort of a stock model that the Fed watches to get a feeling for valuations. Do you know what model she was talking about?
Yeah, they just compare the yield of the 10-year Treasury to the earnings yield of the stock market.
That's it?
Yeah, it's super simplistic, and I'm a big critic of Janet Yellen. We hail from the same university, University of California, Berkeley Business School, and I've had to sit through her through her presentations at the alumni. I'm a big supporter of the school and Alumni Association, and I mean she puts people to sleep. This one, we're not talking the brain of Britain here.
Right. Well, I mean, so she does answer things in a very simplistic way, with not much content or detail. I give you that.
We laugh, but it's tragic,
Oh, it's so tragic. What do you think, what's driving the disconnect between the recent data and the Fed's outlook? It just seems to be two opposing ends.
Well, what's simmering beneath the surface here is they printed a whole boatload of money, and it's beginning to seep into the prices of things. The services CPI is way up, and the energy price. Here we are with $100-something oil, $110 oil in Europe, and the price of that, when you get an energy price spike, we've got, basically a revolution going on in Libya, major oil producer, Iraq, major, one of the top oil producers in the world, all of a sudden looking shaky, So what they have done is, I believe they've set the stage, planted the seeds of the next inflationary crimping of global economy. And she's sitting there,
saying there's no inflation.
Oh, don't worry about it. It's no problem. It's fine. It'll be great. We'll take care of it. And those are I think history is going to be a very bad judge of the central bank policies, particularly Bernanke, and now Yellen is even more blatant about pretending everything is okay, while Rome burns, basically.
The West central banks they say they were sellers of tangible gold for so many years. And I think if the conspiracy nuts are kind of correct, what do you think today is really what gold is worth an ounce? Do you have any idea? I mean, if in fact people start to acknowledge that our currency, at least here, the U.S. dollar or even the yen or the euro, is getting weaker and weaker with this constant printing of money. And then, of course, what do you think gold would be worth?
Great book on that subject. It's called The Death of Money by Jim Rickards. I just spoke at a gold Mines and Money conference in Hong Kong with Jim, and I just finished his book, and he comes up with a number sort of like $9,000 an ounce.
Wow.
Like basically, if you try to balance the amount of money printing that they've done using the measure he used was M1 or M2 or a combination of something, just to get, if you wanted to go back on a gold standard, basically
Do you see us heading to a gold standard?
I think it's possible, and it's certainly, he presents a case for it will be the solution in a international monetary collapse that they will certainly go back to, to use to stabilize things. And in order to do that, you'd have to come up with a level, I believe, that he used something like $9,000, which is so far above current levels.
I know, it's almost unimaginable.
Yeah.
But, look how quickly things are correcting. We seem to be going right side up pretty fast, at least if last week was an indicator. Michael, we've got 1 minute left. I want you to tell people how they could actually get the Belkin Report. It's such an amazing report. My staff and I just eat it up every time it comes in every week.
Well, it's institutional. This is inexpensive. This is not for individual investors. So if you're an institution out there, you could Google me, Belkin Report. It's monitored by MP. It's marketed by MP Research. You can Google that. But it's not really an individual investor newsletter. I work with professional investors, and I'm basically asset allocation for portfolio managers. That's what I do. And basically long, short ideas, overweight this, underweight that, be long this, be short that. It's everything from stocks, bonds, commodities, currencies, et cetera, emerging markets. So, you could Google me, you can find me. Thank you so much for having me on. And again,
Michael, we love having you on. You give such great insight, and you tell people what to do, and they're so desperate out there that, and by the way, your track record is just impeccable when it comes to returns. So if anybody wants to re-listen to the show, you should, and take Michael's advice to heart, because he is very good at this. Michael, thank you so much. And this is Dawn Bennett of Financial Mythbusting. We are going to be talking about the inflation hedge that kind of showed up last week. It was gold and silver. Until then.
WMAL-FM Woodbridge, Washington. WMAL Washington. WRQX HD2, Washington.
This is Financial Mythbusting with Dawn Bennett.
So like I said, last week was very fascinating, I think, to a lot of people, and including your portfolio. And one of the things that really came out strong, and Michael Belkin was talking about this, is gold and silver is actually becoming an inflation hedge. There's this interesting dynamic that took place in the financial markets across the board, but gold and silver really saw some substantial buying interest. I mean, gold went up approximately 3% for the week, and silver hit a 3-month high of 5.92% for the week, if you can believe that. So it's obvious to us that inflation is picking up some considerable steam. And, welcome to the outcome of the mispriced and manipulated markets of the central banks. This is what's going to happen. So you need to think of it this way. If the West central banks have very little gold right now, and they still have this ability to print, which is going to debase the currency, it's going to cause inflation. And then all of a sudden they're going to be wanting to buy gold. So think about what the price would be. Just think about it. We're at $1,300 and change right now. And even Michael was saying that James Rickard, who's been on the show, says, if we didn't have any manipulation going on in the markets, gold would be like at $9,000 an ounce. So I hope this revelation really sinks in for you mentally. And if not, call me or email me next week. I always talk to everybody who calls in. You've just been beaten over the head for at least the last 2 or 3 years to either sell your gold and silver by the media or, potentially your financial advisors. And I'm just saying, don't buy into it. It's been a psychological operation aimed at your finances through your emotions. And I'm hoping it hasn't worked. But if it has, then your job is to unwork it. Stand strong, buy more, and buy for the first time if you haven't done it. Look, we're 100% correct about this, and nothing should get between you and your insurance policy. And if you want to hear more about this this in person from me. We actually are having another seminar on July the 31st, and that's Thursday at the Ritz-Carlton. And all you need to do is RSVP and give me a call at 866-286-2268. Or you can email us, your SVP, at info@BennettGroupFinancial.com. And again, it's at 7 p.m. on Thursday, July the 31st, and we're going to be talking about what asset classes will be working in this new economic era that we are stepping into. And again, I'll say this one more time. We're actually going to be going to Radio America, and we're going into syndication. So we're going to be on dozens of stations throughout America, and it's going to be going from a 1-hour show to a 2-hour show. It's going to be from 10 a.m. to noon on Sunday mornings. And I don't know if we're going to be on WMAL, or the station that we are broadcasting through for you, but make sure you check radioamerica.org for the local stations that you can listen to. And as we go live nationally in mid-July, if you can't listen live, you can always catch the podcast of our 2-hour show on financialmythbusting.com. And we even have all the articles that we talk about that actually get in print each week. And you know what, to everybody out there, you should be asking WMAL if they, want to keep this show, because we are actually in the middle of negotiations with them. And it would be nice to be able to continue to broadcast to the Washington, D.C. area, my home. So thanks so much for listening to Financial Mythbusting. And remember, this is all I've got. This is Dawn Bennett with Financial Mythbusting, where politics and the economy intersect.